Welcome back to the channel. I'm Algabot, and today we're taking an educational look at an expert advisor for MetaTrader 5 called Time Segmented Volume Shift. This is a volume momentum trend strategy built on the Time Segmented Volume Indicator, originally developed by the Wardens brothers. Over the next few minutes, we'll explore how this approach blends price displacement with volume, how it reads accumulation and distribution, and exactly when it signals a long or a short. We'll walk through the logic, the meta editor code, and a candle-by-candle chart illustration. Everything here is for education only, so let's dive in. Let's start with the big picture. Time segmented volume shift is a trend-following strategy that tries to confirm price moves with volume before it acts. The engine at its heart is time segmented volume, or TSV. Unlike simpler volume tools that just add whole sign volume, or that smooth a volume ratio, TSV does something more specific. For every bar, it takes the close-to-close price displacement and multiplies it by that bar's volume. A large up move on heavy volume adds a big positive chunk, while a small move on thin volume barely registers. Those weighted values are then summed over a rolling window to form the TSV line. The idea is that TSV rises fastest when strong price moves are genuinely backed by participation. That footprint is what many traders describe as accumulation, and its mirror image is distribution. On top of the TSV line, the strategy calculates an exponential moving average of TSV itself, which acts as a signal line. The tradable event is the momentum shift, the moment TSV crosses through that signal line, showing that flow is accelerating past its recent average. But a crossover on its own is not enough. The strategy adds two context filters. First, it checks which side of the zero line TSV sits on, because that tells us whether net buying or net selling currently dominates. Second, it uses an exponential moving average of price as a trend baseline, so it only takes crossovers that agree with the prevailing direction. This EA runs on any liquid symbol and on whatever single primary time frame you select at backtest time, and it uses tick volume as its volume proxy. Who is this style suited for? Educationally speaking, it's an interesting study for traders who like trend-following systems, but want volume behavior woven into the entry decision rather than price alone. As always, remember that trading carries real risk, losses do happen, and nothing here is financial advice. This is a study of how the code behaves. Now let's walk through the mechanics step by step. Everything begins with the flow calculation. For each closed bar, the EA takes the change in price from the previous close to the current close and multiplies that displacement by the bar's tick volume. This gives a signed, magnitude-aware value. It is positive when price closed higher, negative when price closed lower, and larger when volume was heavy. The strategy then sums these flow values over a rolling window whose length is set by the TsvPeriod parameter, which defaults to 18. That rolling sum is the time segmented volume line. Next, the EA smooths TSV with an exponential moving average over the signal period, which defaults to 7 bars. This is the signal line, and the crossover between TSV and this line is the core event. Alongside this, the strategy tracks an exponential moving average of price over the trend period, defaulting to 60 bars, and measures its slope over the last 3 bars to judge the regime. For a long, 3 conditions must line up together. TSV must cross upward through its signal line. TSV must also be above 0, confirming net accumulation. And price must be trading above the trend baseline while that baseline is rising. When all 3 agree, the EA signals a buy. For a short, the mirror applies. TSV crosses downward through its signal line. TSV sits below 0 for net distribution, and price trades below a falling baseline. Every trade is framed by risk controls derived from the average true range. The stop loss is placed a set number of ATR multiples away from entry, using the ATR stop multiple parameter, which defaults to 2. The take profit sits at the ATR target multiple, defaulting to 3, giving a reward to risk shape of roughly 3 to 2 on those defaults. There is also a protective exit. If, while a position is open, TSV crosses back through its signal line against that position, the EA reads the flow thesis as having failed and closes the trade early. Finally, the strategy holds only one position per magic number at a time, so it never stacks entries. It simply waits for the next clean setup. Let's read through the actual meta editor code on screen. At the top, we have the input parameters. TsvPeriod is the rolling window for the volume sum, defaulting to 18. SignalPeriod, at 7, sets the exponential moving average that becomes the signal line. TrendPeriod, at 60, is the price baseline. Then ATR-period, the stop multiple, and the target multiple size the risk. Lots sets the order volume, and magic tags the trades. Below that, for Boolean flags carry the whole decision. The cross-up flag is true when TSV was at or below its signal on the prior bar and is now above it. The cross-down flag is the exact opposite. The up flag confirms price is above the baseline and the slope is positive, and down confirms price is below a falling baseline. Now look at the long block. The condition reads, if up and cross up and TSV now above 0. When all three are true, the code reads the ask price as its entry, sets the stop loss 1 ATR stop multiple below entry, sets the take profit the target multiple above, and calls trade.buy with the accumulation comment. The short block is the mirror. If down and cross down and TSV now below 0, it reads the bid price, places the stop above entry, the target below, and calls trade.sell with the distribution comment. Notice both sides normalize their prices to the symbol's digits, so the orders are valid. Same structure, opposite direction. This is educational, not advice. Let's walk through this illustration candle by candle. On the price chart, you can see the blue EMA trend baseline weaving beneath the candles, and in the panel below sits our engine, the time segmented volume line in gold with its signal line in blue, plotted around a 0 line with an accumulation zone above and a distribution zone below. Look at the first two candles. Price is drifting sideways to slightly lower, and notice the second candle dips. In the panel, the gold TSV line has slipped just below its blue signal line, and it's hovering near 0. There is no agreement here, so the strategy simply waits. Nothing lines up yet. Now watch the third candle, our buy entry marker. Price pushes up and closes back above the rising EMA baseline. At the very same moment, in the panel below, the gold TSV line crosses upward through its blue signal line, and crucially it does so while sitting above the 0 line, inside the accumulation zone. That is the full picture the strategy waits for. Price above a rising baseline, net accumulation, and flow accelerating. The EA signals along at the buy entry marker, placing its stop below, sized from the average true range, and its target above. Candles 3, 4, and 5 carry the move higher. Each candle closes above the last. TSV stays elevated inside the accumulation zone, and volume-backed buying keeps the flow strong. By the fifth candle, price reaches the take profit marker. That target sits at 3 ATR multiples from entry against a 2 multiple stop, so the reward to risk shape here is about 3-2. The long is complete. Now the character of the market changes. On the 6th, 7th, and 8th candles, price rolls over from the highs. The EMA baseline flattens and begins to tip downward, and in the panel the gold TSV line is fading from its peak, while the signal line finally catches up. The strategy holds off, because although flow is weakening, price has not yet confirmed a downside regime. Watch the 9th candle, our sell entry marker. Price closes clearly below the now falling EMA baseline. At the same instant, the gold TSV line drops sharply and crosses down through its blue signal line, and it does so below the 0 line, inside the distribution zone. That is the mirror of our earlier setup. Price below a falling baseline, net distribution, and flow accelerating to the downside. The EA signals a short at the sell entry marker, placing its stop above and its target below, again sized from ATR. Candles 10, 11, and 12 extend the decline. Each candle prints a fresh low, TSV stays pinned in the distribution zone, and the selling pressure carries price down to the take profit marker on the 12th candle. The short reaches its target, and the trade is complete. Notice on the final candle how price steadies and TSV begins to curl back towards 0. Had a position still been open, remember the protective rule. A TSV cross back against the trade would prompt an early exit before the ATR levels are even reached. That, candle by candle, is how time segmented volume shift reads volume-backed momentum in both directions. And that brings us to the end of our study of time segmented volume shift. We looked at how the strategy weights each bar's price displacement by its volume to build the time segmented volume line, how a crossover with its signal line marks a momentum shift, and how the zero line and an EMA baseline keep entries aligned with accumulation, distribution, and the prevailing trend. We also walk through the meta-editor code and a full long and short example on the chart. Please remember that everything in this video is educational content only and not financial advice, a recommendation, or a solicitation to trade. Trading involves real risk, and losses do occur. If you found this analysis helpful, consider liking the video, subscribing for more MetaTrader 5 strategy breakdowns, and leaving a comment with the strategy you'd like us to study next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.